Hi everyone, this is Rohit Srivastav, the founder of IndiaCharts, and IndiaCharts has been around for a long period of time. In fact, I've been writing this blog all the way since 1999. Only that back then it was not IndiaCharts.com, it was some free page on GeoCities IndiaCharts because the IndiaCharts name had still not become available. Yes, that's the Y2K bubble. Everybody was squatting on domain names, and once the IT bubble was behind us, everybody left those domain names. There were no buyers for every domain name possible on the planet, and they all became available. And so that's when I latched on to IndiaCharts.com. Some people ask me, how did I come up with the name? And the name really emerged to me because of reading another blog on various markets with some very, very simple form of analysis by a very old technician known as Barton Biggs, and he was writing something known as AsiaCharts.com. And so I used to read it every week, and I said, hey, why don't I start writing IndiaCharts.com? And so that's the emergence of the name, just to give you some historical insight. And like I said, during the IT bubble, the name was not available. Then it became available, and I latched onto it. And so that's how it has come to be. And so I was writing the blog with my market analysis since way back then, and it was just a one-pager, no archives, no history. That was a big complaint that Shri Tarun Bhai had, with me always, because whenever he wanted to refer to it and tell people, see, this is what he said, there was no historical context to it to really show. And that's because I did not really think of going on to a proper CMS website, blog, or a paid platform. The idea was just to share every week. So I just updated the HTML page, and so it remained without archives. But then I did start writing about it on Google Groups. I think, I don't remember the year, but it was probably 2008-9. And since then, at least those archives are available. And the website itself is, live as a CMS from 2012-13. And people have been subscribing and reading about it, about my work since then. So that's how it has emerged. So we do have the entire history of every post I've done since 2012, and you can actually search it. In fact, every post more than 6 months old on the site has been made free. So if you really like reading older material and learning from it, it is a great place to learn, understand economic cycles, Elliott wave analysis, how it is done, the accuracy, etc. Does it work? Doesn't it work? A lot of questions, right? Newbies actually have a lot of these questions about the context of Elliott wave analysis and its workability. And I think by making it free, it really puts that into context, right? I don't have to really make any tall claims about whether something works, doesn't work, happens. You can check it out yourself. So that's how I've really done it, and that's why it's very, very real. And so decisively, because I'm simply sharing my views and analysis without really recommending any stocks, which is not the purpose of the platform, I really have chosen not to be an investment advisor. I don't manage any more money. I did that when I was still at Sharekhan under portfolio management services, and there too I ran something very, very different, which is long short funds, managed futures, and different line of products where we tried to do something unique in the PMS space. I stepped out 2019, and I've been with IndiaCharts ever since. So it's been a long journey since then, because we moved on. And Chavan, some of you who know Chavan, and especially if you've been speaking to him, calling him, or been online for any of the offers that we have. For example, he's been running a Diwali offer for those who want to subscribe to the platform, 25% off. Today was the last day, but if you get in touch with the team, they might still help you out. So you can go online and get those special rates for the day. And if you, like I said, if you've spoken to Chavan, he joined me in 2019, and we started the mentorship program. Now, again, as everything that I do, I've always tried to keep it unique, keep it different, and a little of idealism. Like they say, you shouldn't be idealistic in business, but that is how I am. So for me, idealism is I trade and invest for myself. I only share my analysis through the blog. I don't take anyone's money. I don't advise anybody. And similarly, when we teach, we don't do one-day programs, two-day programs, weekend lessons, and all of that. And I know that could be easy. You could make it cheaper, and everybody could do small lessons over time. But my idea was that if you're serious about market analysis, doing it yourself, learning how to count waves, for example, which people think is a difficult art, then you need to spend time doing it, spend time learning all of technicals, the basics, momentum indicators, divergences, chart patterns, then come to Elliott waves, then understand position sizing, trade management, portfolio analysis, and all of that, economic cycles. How does all this blend together? How does Elliott waves blend with fundamentals? Blah, blah, blah. And so that became a full length 3-month plus program where you become a lifetime member and stay with us when you take the entire course. That is how we started the mentorship program in 2019 with Chavan joining me. He said, this is what we should do. I said, yeah, but I'll do it only this way. And he agreed. So this is what we've been doing. All the videos that we've put together for the entire 3-level program are now available. They are available in separate levels, so you can look at them independently. But I really like doing, like people who do the entire program, and there are special benefits if you do that. So that's the second thing I ended up doing. So I'm giving you a little historical context for those who are new to the blog or the platform as to where we come from, and then I'll talk about the market and where we think the market's going. Last and not the least, strike. Last 2 years we spent everything that we earned with all the other activities into developing the one-stop platform where you can get all market data analytics and be able to do your own analysis. So it's very simple that if I could do my own analysis, using certain information data apart from wave counting that you have to learn, then all that data and information, a lot of which was 20 years of, say for example, advanced decline breadth data of the market, which was on Excel sheets. We wanted to put it all on a platform and make it available to people and update it every day automatically with the automation technology and at an affordable price. And that is sort of how Strike evolved. 2 years plus of investing in the product, completely bootstrapped till a couple of months back. And even then it's mostly crowd-funded, so we're really not going with VCs or with any angel investors so far. And that's how we really thought of it, so that we can go about building it exactly the way that we want, without the unnecessary pressure of going in a particular direction because it maybe makes more business sense. I don't know, but I wanted the right product, which is where you should be able to do your own analysis, get the results, find the stocks you want, and be able to take a market view. And taking a market view is where sentiment indicators were a very, very important part. And that brings me to the discussion for the day, which is where is the market today? And sentiment plays a very, very important role in this, along with Elliott wave analysis when we look at the entire trade setup. So when we are looking at sentiment at the start of September, if you actually look at, and what is sentiment? Basically, you're trying to measure diffuse various types of data and information from the market and know whether everybody is bullish or everybody is bearish, right? We want to be a contrarian. We've all heard that. We've read it in books. But how do you become a contrarian? You have to do that based on information and data. So you have to check, is everybody long? Is everybody short? The data is available from the futures and options market. The data is available from NSE that gives you the participant-wise data every day. There's breadth data which comes from the BSE. There's so much other information, put-call ratios, volume of puts traded and to calls traded. And I can simply go on. There are a dozen of indicators under sentiment and diffusion. These are the two sets of tools which allow us to first take a view on where the market is likely to head from here. And then we actually try to do analysis of stocks and find which stocks you really like or which sectors you should be in. So this is a 2-3 stage process that we sort of try to inculcate into your thought process, and all the tools therefore are available to do that on the Strike platform. So where do you find Strike? web.strike.money. Just go to web.strike.money and start your 7-day free trial. And it's again at a throwaway price of $650 per month. After that, I'm sure you'll love it. So coming to what are the sentiment indicators really telling us at this moment? So at the start of September, like I was saying, we were in an excessively bullish environment, which means if you simply looked at the positioning of FIs in the index futures market, they were extremely long. In fact, they had the highest long position in the month of July or August. And after cutting back on that, they added all those longs back into early September. So even though it had not crossed the July reading, it was almost back to the same reading. And so that was like a 10-year high or something in the index futures positioning by FIs. The last time they had a reading close to that, it was just before demonetization. So that's around 2016. So it's not exactly 10 years, but yeah, 7-8 years. And imagine we got to those kind of levels. So there was an excess that needed to be unwound. And it started happening in the mid caps first. So through September, even though the Nifty made a new all-time high, the mid cap started to correct first. And then in October, we finally seen the correction percolate into the large caps. And in doing so, when you look at the diffusion indicators, and there's one that somebody's actually posted on Twitter, and this one is the number of Nifty or Nifty 500 stocks. I think he's published Nifty, but even if you take Nifty 500 for a larger basket, percentage of stocks above the 50-day moving average, that actually dropped to sub 10%, okay, or close to 10%. And that is a reading that tells you that most stocks have fallen. They've all fallen, and which is why you're getting such a low reading, which means that 90% of the stocks are now below the 20-day average, and only 10% are above. The reading at the start of October was a large negative divergence between the start of September and start of October. So like I said, mid-caps had started to correct already, though you may not see it in a big fall in the mid-cap index, but individual stocks falling reflected in the number of stocks below the 50 DMA going up, and therefore a negative divergence in the indicator even when the Nifty was making a new all-time high in the first week of October. That negative divergence has eventually led to a very steep correction, and now the indicator is getting oversold. So this is where we are today. Now, where have FII positions gone? They've gone from being extremely long to being short. They're not in the extreme short territory, but we are pretty close. The client side position is close to extreme short, long territory. So what is the client side position? Client is basically includes everything from HNIs, large investors, traders, individuals as well, corporates, everything which is not prop, DII and FII goes into client. So it's a lot of, it's the largest basket, and it's the most opposing force to the FII. Now, I know in the cash market, the biggest opposing force is DII. DII has also become pretty large in the futures and options market, but their positioning can sometimes be very, very different. But as far as, the index futures is concerned, historically, the client side has been pretty large. And whenever they are excessively long, you do get closer and closer to a bottom. And they've been long for a week or more, maybe 10 days or 15 days. But that position was closer to an extreme based on historical context than the FII positioning. But the FIIs were short. And so there was a case for that to happen. But as always, when the trend is still down, we wait for that trend to complete, not just on a price basis, but an Elliott wave basis. On a price basis, we also look at momentum. And I have my proprietary Rohit momentum indicator. In short, we call that RMI, which is also on the Strike platform, which is on web.strike.money. So when we look at RMI, which is a slightly faster, smoother momentum indicator than those currently I see on most free platforms, and that had given a bullish crossover, a couple of days back. And after that, the Nifty still made a new low. So we sort of have a positive divergence now with the indicator and Nifty price action. So that was the first advance warning of a possible trend change. The last and final one is, of course, the Elliott wave count itself, which I do believe today shows completing of a large ABC correction from the October top. So an ABC correction essentially is a three-wave correction that can mark the end of a corrective phase, or it can mark the first leg of a corrective phase. One of the two. We usually don't know which till much later. But when you complete an ABC correction, you want to be on the bullish side. So that's sort of where we are right now. And I'm saying this right ahead of the US election results data that will start flowing in from tonight into the morning as the US goes to vote. Sometimes you will know the end results within a day. Some results of certain states that go into dispute, you might only come to know after the next 5 to 10 days. But you broadly get an idea of which way the country is really swinging, and that will cause markets to have certain reactions. I sense that since you haven't really seen much of a reaction, but you have seen a short-term correction in, I think, various other markets, Europe to US. I think most markets other than US have corrected more than the US. So I think the world is more fearful than the US itself about the election result. And historically, US markets have seen a correction ahead of the elections, and then after that they've actually rallied, usually what they call as a presidential rally. No matter who wins, you always had a stock market rally after the elections. That's just history. Will that history repeat this time as well? Now, the timing is also interesting because it's end of October, early November, and seasonally you go into a bullish period between November, December, or into early Jan. And because you have many of these things coming together, it may be a good time to say, well, sentiment has turned from bullish to extremely bearish. We have an ABC correction. Number of stocks below the 50-day average at 10% shows excessive pessimism. And from that point of view, entering into a seasonally bullish period, election results coming in the next 2 days, we should be heading into a bullish phase for markets all over again. And that is, I think, the immediate setup. At least that should last for the next couple of weeks or the next 2 months. And then we'll, of course, take it from there as to what happens next. But this is what the overall setup is. I've sort of given you a complete, roundabout insight into what has happened. And all this one day after I just returned from my Diwali holiday. So I've been around. If you're really following me on Twitter at IndiaCharts, then you would have seen my pictures and gotten an idea where I've been. But the main point is taking a break can sometimes clear your head. Things can look extremely difficult at one point of time, because while this correction was going on, you did have a rally in the US dollar, and you did see US bond yields actually start going up. Now, that's a pretty risky factor coming onto the table, especially at a time when interest rates are supposed to be going down, and we are due for more rate cuts. But what we are really hearing and what we are really seeing in the bond yields is the bond yields actually going up. And so that contrarian thought has been, knocking at the door and telling us to think about the potential of a risk in markets from, the bond side, because no matter who wins the US election, they're going to be borrowing and spending more. And that's, I think, the fear that the bond market is dealing with. On the other side, you can, you can get the pacify and put it on, believing that the Fed has your back, because, well, they're not going to let the bond market fall apart. They'll probably start buying bonds if it goes too far, and they're anyway going to cut rates. So you have these two conflicting thoughts, which are always at loggerheads. But in the end, it is policymakers that decide which way these things head. And if you don't, and it's possible that, this entire reaction that we are seeing in US equities since only the 18th of October, pretty late reaction and not a very big one compared to the last couple of times. And similarly, the bond market and the dollar have all reactions to the election itself. And once the election, the event itself is behind us and it's all discounted, you'll see these trends reverse. So that's also very much possible. And so the fears and risks that revolve around it would go away. Now, one reason to think so is that even though yields went up, you haven't seen much of a reaction in equities. So equities are discounting it, saying, yeah, there's nothing much, it's just maybe a temporary reaction. Same thing you're seeing in some of the commodities. We did see a sell-off in oil. We did see some correction in aluminium prices, but aluminium prices didn't really go below their lower band or the 40-50-day average. They found support there and bounced back. Copper, for example, has retraced 61% of its last rally and really not fallen below that, in fact going higher today. So all these markets which are directly impacted by the dollar or by rising interest rates are really not fearful at this moment. And that is the interesting takeaway a day before the election results come, which people are creating so much hype and fear over that God knows if Harris comes, the markets will crash, or if Trump comes, this will happen. But history shows it doesn't matter who comes, markets have a presidential rally. So and seasonally this is a bullish period. So net, I think my conclusion is that we should be open for positive outcomes from here. And those positive outcomes could be small or big depending on how some of these patterns unfold. If you do get a significant decline in interest rates or bond yields following the event, then that would be very much in line with what the Fed is saying and what the inflation data has been showing for a while. And that can continue to trigger markets positively. So that is the other side. But at the same time, we will watch if this rally does fizzle out, it's not able to get past certain retracements. Those are risks that we will always, continue to watch on a day-to-day basis. And I'll continue to write about it on the IndiaCharts platform. But my immediate thought is that as we've come to the end of October, the September is usually the worst, well, not the worst, maybe the second worst month of the year in terms of returns. And from October into November, December, we start seeing that number get elevated. And so you actually see a positive swing in markets. And that is where we are right now. If you want to actually look at a chart of the seasonality of the Nifty, you can go to Strike and check it out under Nifty. Check out the seasonality. You can zoom up that screen and have a line graph plotted, or you can simply look at the month-on-month numbers, and you can do that for any stock, any index that you like. and build your case around it. So that's all from me for today. I think I've given you sufficient insight on what I think markets are likely to do in the weeks or months ahead. And until next time, see you all. Don't miss the 25% off on the IndiaCharts subscriptions, the annual 1 year, 2 year subscriptions, which are still open. So you can go and try that out, or simply start your 7-day free trial with web.strike.money. Thank you.